Tantor Audio, a division of Recorded Books, presents Exchange-Traded Funds for Dummies, 3rd edition, by Russell Wild, MBA. Narrated by Chris Sorensen. Publisher's Note: in this audio edition, you will hear references to figures and tables present in the print and ebook formats of the book. Limit of liability, disclaimer of warranty. While the publisher and authors have used their best efforts in preparing this work, they make no representations or warranties with respect to the accuracy or completeness of the contents of this work, and specifically disclaim all warranties, including without limitation any implied warranties of merchantability or fitness for a particular purpose. No warranty may be created or extended by sales representatives, written sales materials, or promotional statements for this work. The fact that an organization, website, or product is referred to in this work as a citation and/or potential source of further information does not mean that the publisher and authors endorse the information or services the organization, website, or product may provide or recommendations it may make. This work is sold with the understanding that the publisher is not engaged in rendering professional services. The advice and strategies contained herein may not be suitable for your situation. You should consult with a specialist where appropriate. Further, readers should be aware that websites listed in this work may have changed or disappeared between when this work was written and when it is read. Neither the publisher nor author shall be liable for any loss of profit or any other commercial damages, including but not limited to special, incidental, consequential, or other damages. Introduction. Every month, it seems, Wall Street comes up with some newfangled investment idea. The array of financial products, replete with 164-page prospectuses, is now so dizzying that the old lumpy mattress is starting to look like a more comfortable place to stash the cash. But there is one product that is definitely worth looking at, even though it's been around not even 30 years. It's something of a cross between an index mutual fund and a stock, and it's called Exchange-Traded Fund, or ETF. Just as computers and fax machines were used by big institutions before they caught on with individual consumers, so it was with ETFs. They were first embraced by institutional traders, investment banks, hedge funds, and insurance firms because, among other things, they allow for the quick juggling of massive holdings. Big traders like that sort of thing. Personally, playing hot potato with my money is not my idea of fun. But all the same, over the past not even 20 years, I've invested most of my savings in ETFs, and I've suggested to many of my clients that they do the same. I'm not alone in my appreciation of ETFs. They have grown exponentially in the past few years, and they will surely continue to grow and gain influence. While I can't claim that my purchases and my recommendations of ETFs account for much of the growing global $9 trillion plus ETF market, I'm happy to be a very small part of it. After you've read this 3rd edition of Exchange-Traded Funds for Dummies, you may decide to become part of it as well, if you haven't already. Since the 1st edition. Many changes have taken place in the investment world, both on Wall Street and Main Street, since the 1st edition of this book was published in 2007. For one thing, a much larger pot of money, dollars, euros, yen, is now invested in ETFs. $9.1 trillion as of this writing, up from a mere $800 billion in 2007. Also, when I introduce myself as the author of Exchange-Traded Funds for Dummies, I no longer get a look as if I'm speaking some strange language with a lisp. Many people today, perhaps most, are at least somewhat familiar with the term exchange-traded funds. ETFs have, after all, made a few headlines. Out of the shadows. The rising popularity of ETFs has been a news story in and of itself. Many educated folks are now aware that ETFs are low-cost investment vehicles that can serve as building blocks for a diversified portfolio. And that is what I concentrate on most in this third edition: how ETFs may be used by you, the individual investor, to maximize your investment returns while minimizing risk. I tried to do that same thing in the first and second editions, but since then, without question, there have been many changes, both positive and negative. Today, you'll find a much greater selection of ETF offerings, although not all of them are prizes. Filling the investment voids. One very positive change in the past several years is that the black holes that I identified in the first edition of this book have largely been filled. That is, when I wrote the first edition, you could not buy an ETF that would give you exposure to tax-free municipal or high-yield bonds, or international bonds, or international REITs. All that has changed. There are now ETFs that represent all those asset classes and many more. Building an entire well-diversified portfolio out of ETFs was not humanly possible several years ago. It is very possible today. I've done it numerous times. Another very positive development: ETFs have recently been making a grand entrance into employer-sponsored 401k plans, where many of America's hardworking people store the bulk of their savings. And they've been appearing lately in 529 college savings plans, too. Insurance companies have also jumped into the fray, offering ETFs in some of their annuity plans, which unfortunately are still often overpriced. Creations of dubious value. Many of the newer ETFs are bad investments, pure and simple. They were introduced to take advantage of the popularity of ETFs. They are overly expensive and they represent foolish indexes, extremely small segments of the market, or indexes constructed using highly questionable methodologies. Much of this book is designed to help you tell the good from the bad. Many of the newer ETFs are also specifically designed for short-term trading, which you would know if you read the really small print at the bottom of the advertisements, and short-term trading usually gets small investors into big trouble. A scary number of the newer ETFs are based on back-tested models. They track whatever indexes or invest in whatever kinds of assets have done the best in recent months or years. These ETFs, or the indexes they track, have shining short-term performance records, which induce people to buy. But past short-term performance is a very, very poor indicator of future performance. A number of new ETFs are focused on meme stocks. Those stocks most highlighted on social media, often ballyhooed in memes as surefire ways to get rich. I could say Tesla right now, but by the time you're reading this, Tesla will be out and some other company will be in. Buying what's most fashionable by investing directly in the meme stocks or in an ETF filled with meme stocks is not a wise investment move. Morphing into new creatures. Actively managed ETFs that might, for example, buy and sell meme stocks have been much slower to take off than Wall Street had hoped, but have made inroads since the first edition of this book. These ETFs differ radically from the original index ETFs. Actively managed ETFs don't track any indexes at all, but instead have portfolios built and regularly traded by managers attempting to beat the indexes. Study after study has shown that active management usually doesn't work all that well for investors, even though the managers themselves often get very rich. More in Chapter 18. Some of the newest ETFs, called defined outcome ETFs, are everything that an ETF shouldn't be: actively managed, expensive, and almost absurdly complex. Whereas other ETFs are cousins of mutual funds, these complicated funds are more like variable annuities. About this book. As with any other investment, you're looking for a certain payoff in reading this book. In an abstract sense, the payoff will come in your achieving a thorough understanding and appreciation of a powerful financial tool called an exchange-traded fund. The more concrete payoff will come when you apply this understanding to improve your investment results. What makes me think ETFs can help you make money? ETFs are intelligent. Most financial experts agree that playing with individual stocks can be hazardous to one's wealth. Anything from an accounting scandal to the CEO's sudden angina attack can send a single stock spiraling downward. That's why it makes sense for the average investor to own lots of stocks or bonds through ETFs or mutual funds. ETFs are cheap. At least 250 ETFs charge annual management expenses of 0.10% or lower, and a few charge as little as 0.00% a year. In contrast, the average actively managed mutual fund charges 0.63% a year. Index mutual funds generally cost a tad more than their ETF cousins. Such cost differences, while appearing small on paper, can make a huge impact on your returns over time. I crunched some numbers in Chapter 2. ETFs are tax smart. Because of the very clever way ETFs are structured, the taxes you pay on any growth are minimal. I crunched some of those numbers as well in Chapter 2. ETFs are open books. Quite unlike mutual funds, and ETFs holdings are, by and large, readily visible. If this afternoon, for example, I were to buy 100 shares of the ETF called the SPDR, pronounced SPDR S&P 500 ETF Trust, I would know that exactly 6.37% of my money was invested in Apple Inc., and 5.92% was invested in the Microsoft Corporation. You don't get that kind of detail when you buy most mutual funds. Mutual fund managers, like stage magicians, are often reluctant to reveal their secrets. In the investment game, the more you know, the lower the odds that you will get sawed in half. Newsflash. Regulators are still debating just how open the portfolios of the newer actively managed ETFs will have to be. For the time being, however, most ETFs track indexes, and the components of any index are readily visible. And speaking of open books, if the one you're now reading were like some, but certainly not all, mutual funds, it would be largely unintelligible and expensive. It might be doubly expensive if you tried to resell the book within 90 days. Luckily, this book is more like an ETF. Here's how. Exchange-traded Funds for Dummies is intelligent. I don't try to convince you that ETFs are your best investment choice, and I certainly don't tell you that ETFs will make you rich. Instead, I lay out facts and figures and summarize some hard academic findings, and I let you draw your own conclusions. Exchange-traded Funds for Dummies is cheap. Hey, top-notch investment advice for only $29.99, plus or minus any discounts, shipping, and tax. Where else are you going to get that kind of deal? And should you come to the conclusion after reading this book that ETFs belong in your portfolio, you'll likely get your $29.99, plus any shipping costs and tax, back, in the form of lower fees and tax efficiency in no time at all. Exchange-traded Funds for Dummies is tax smart. Yes, the money you spent for this book, as all other outlays you make for investment advice, may be deducted from your federal income taxes, provided you itemize your deductions. Go for it. Exchange-traded Funds for Dummies is an open book. You've already established that. If you've ever read a For Dummies book before, you have an idea of what you're about to embark on. This is not a book you need to read from front to back. Feel free to jump about and glean whatever information you think will be of most use. There is no quiz at the end. You don't have to commit it all to memory. Foolish assumptions. I assume that most of the people reading this book know a fair amount about the financial world. I think that's a fairly safe assumption. Why else would you have bought an entire book about exchange-traded funds? If you think that convertible bonds are bonds with removable tops and that the futures market is a place where fortune tellers purchase crystal balls, I help you along the best I can by letting you know how to find out more about certain topics. However, you may be better off picking up and reading a copy of the basic nuts and bolts Investing for Dummies by Enticing, published by John Wiley & Sons, Incorporated. After you spend some time with that title, come on back to this book. You'll be more than welcome. Icons used in this book. Throughout the book, you'll find little globular pieces of art in the margins called icons. These cutesy but handy tools give you a heads up that certain types of information are in the neighborhood. Tip: although this is a how-to book, you'll also find plenties of whys and wherefores. Any paragraph accompanied by this icon, however, is guaranteed pure 100% unadulterated how-to. Warning: the world of investments offers pitfalls galore. Whenever you see the bomb icon, know that there is a risk of your losing money, maybe even big money, if you skip the passage. Remember: read twice. This icon indicates that something important is being said and is really worth putting to memory. Technical stuff. If you don't really care about the difference between standard deviation and beta, or the historical correlation between U.S. value stocks and REITs, feel free to skip or skim the paragraphs with this icon. Greed alert. The world of Wall Street is full of people who make money at other people's expense. Where you see the starburst icon, I'm describing an instance where someone may try to sucker punch you and take your loot. Beyond the book. Aside from the information in this book, you have access to even more help and information online at dummies.com. There you can find information on all manner of topics. Dummies.com is also where you'll find the Exchange-Traded Funds for Dummies cheat sheet, which suggests topics to discuss with your financial professional, explains how to choose the best ETFs, and succinctly explains how ETFs differ from mutual funds. Where to go from here? Where would you like to go from here? If you want, start at the beginning. If you're interested only in stock ETFs, hey, no one says that you can't jump right into Part 2. Bond ETFs? Go ahead and jump to Part 3. It's entirely your call. Part 1. The ABCs of ETFs. In this part, delve into the early history of ETFs and their development ever since. Find out what makes ETFs so special and what makes them such darned good investments. Discover where and how ETFs are created and traded. Chapter 1. No longer the new kid on the block. In this chapter, discovering the origins of ETFs, understanding their role in the world of investing today, getting a handle on how ETFs are administered, finding out how ETFs are bought and sold, tallying the phenomenal growth of ETFs. There are no doubt a good number of pinstriped ladies and gentlemen on and around Wall Street who froth heavily at the mouth when they hear the words exchange-traded fund. In a world of very pricey investment products and very well-paid investment product salespeople, ETFs have been the ultimate killjoys. Since their arrival on the investment scene in the early 1990s, some 3,300 ETFs have been created, and ETF assets have grown faster than those of any other investment product by far. That's a good thing. ETFs enable the average investor to avoid shelling out fat commissions or paying layers of ongoing unnecessary fees. And they've saved investors oodles in taxes. Hallelujah! In the beginning. When I was a lad growing up in the burbs of New York City, My public school educators taught me how to read, write, and learn the capitals of the 50 states. I also learned that anything and everything of any importance in this world was, invented in the United States of America. I've since learned that, well, this isn't entirely true. Take ETFs. The first ETF was introduced in Canada. It was a creation of the Toronto Stock Exchange. No Wall Streeters were anywhere in sight. I'm afraid that the story of the development of ETFs isn't quite as exciting as, say, the story behind penicillin or modern rocketry. As one Toronto Stock Exchange insider once explained to me, we saw it as a way of making money by generating more trading. Thus was born the original ETF known as TIP, which stood for Toronto Index Participation Unit. It tracked an index of large Canadian companies, Bell Canada, Royal Bank of Canada, Nortel, and 32 others, known as the Toronto 35. That index was then the closest thing that Canada had to the Dow Jones Industrial Average Index that exists in the United States. Enter the traders. TIP was an instant success with large institutional stock traders who saw that they could now trade an entire index in a flash. The Toronto Stock Exchange got what it wanted, more trading, and the world of ETFs got its start. Technical stuff. TIP has since morphed to track a larger index, the so-called S&P/TSX 60 index, which, you probably guessed, tracks 60 of Canada's largest and most liquid companies. The fund also has a different name, the iShares S&P/TSX 60 Index ETF, and it trades, in Canada, under the ticker XIU. It is now managed by BlackRock Inc., which, upon taking over the iShares lineup of ETFs from Barclays in 2009, part of a juicy $13.5 billion deal, has come to be the biggest player in ETFs in the world. I introduce you to BlackRock and other ETF suppliers in Chapter 3. A completely different BlackRock-managed U.S. ETF now uses the ticker TIP, but that fund has nothing to do with the original TIP. The present-day TIP invests in U.S. Treasury inflation-protected securities. Moving south of the border. The first ETF didn't come to the United States for 3 or so years after its Canadian birth. Oh, how my public school teachers would cringe. On January 22, 1993, the mother of all U.S. ETFs was born on the American Stock Exchange, which in January 2009, a big year for mergers and acquisitions, became part of NYSE Euronext. The first U.S.-based ETF was called the S&P Depositary Receipts Trust Series 1, commonly known as the SPDR S&P 500, and it traded and still does under the ticker symbol SPY. The SPDR S&P 500, which tracks the S&P 500 index, an index of the 500 largest U.S. companies, was an instant darling of institutional traders. It has since branched out to become a major holding in the portfolios of many individual and institutional investors, and a favorite of favorites among day traders. Fulfilling a dream. ETFs were first embraced by institutions, and they continue to be used big time by banks and insurance companies and such. Institutions sometimes buy and hold ETFs, but they are also constantly buying and selling ETFs and options on ETFs for various purposes, some of which I touch on in Chapter 23. For us non-institutional types, the creation and expansion of ETFs has allowed for similar juggling, usually a mistake for individuals, but more importantly, ETFs allow for the construction of portfolios possessing institutional-like sleekness and economy. Goodbye ridiculously high mutual fund fees. The average mutual fund investor with a $150,000 portfolio filled with actively managed funds will likely spend $945, 0.63% in annual expenses per the Investment Company Institute and Morningstar. By switching to an ETF portfolio, that investor might incur, if they incur any trading costs at all, perhaps $50 or so to set up the portfolio, and maybe $20 or so a year thereafter. But now the investor's ongoing annual expenses will be about $270, 0.18%. That's a difference, ladies and gentlemen of the jury, of big bucks. We're looking at an overall yearly savings of $625, or more if your brokerage has eliminated trading commissions altogether, which many have. Keep in mind that your $625 or more a year will be compounded every year the money is invested. Remember, loads, those odious fees that some mutual funds charge when you buy or sell their shares, simply don't exist in the world of ETFs. Capital gains taxes, the blow that comes on April 15th to many mutual fund holders with taxable accounts, hardly exist. In fact, here's what my predominantly buy and hold clients with their taxable money in ETFs have paid in capital gains taxes in the past 3 years. $0. In Chapter 2, I delve much deeper into both the cost savings and the tax efficiency of ETFs. Hello, building blocks for a better portfolio. In terms of diversification, my own and my clients' portfolios include large stocks, small stocks, micro-cap stocks, English, French, Swiss, Japanese, and Korean stocks, intermediate-term bonds, short-term bonds, and real estate investment trusts, REITs, all held in low-cost ETFs. I discuss diversification and how to use ETFs as building blocks for a Class A portfolio in Parts 2 and 3. Yes, you could use other investment vehicles such as mutual funds to create a well-diversified portfolio, but ETFs, at least most ETFs, make it much easier because they tend to track very specific indexes. They are, by and large, much more pure investments than mutual funds. An ETF that bills itself as an investment in, say, small growth stocks is going to give you an investment in small growth stocks, plain and simple. A mutual fund that bills itself as an investment vehicle for small growth stocks may include everything from cash to bonds to shares of Microsoft. No kidding. And I give you other examples in the next chapter. Will you miss the court papers? While scandals of various sorts, hidden fees, soft money arrangements, after-hours sweetheart deals, and executive kickbacks have plagued the world of mutual funds and hedge funds, this is the number of ETF scandals that have touched my life or the lives and fortunes of my clients. 0. That's in good part because the vast majority of ETF managers, forced to follow existing indexes, have very little leeway in their investment choices. Unlike many investment vehicles, ETFs are closely regulated by the U.S. Securities and Exchange Commission, and ETFs trade during the day in plain view of millions of traders, not after hours as mutual funds do, which can allow for sweetheart deals when no one is looking. In Chapter 2, I discuss in greater detail the transparency and cleanliness of ETFs. Not quite as popular as the Beatles, but getting there. With all that ETFs have going for them, I'm not surprised that they have spread like mad. Per the Investment Company Institute, there were, at the beginning of 2000, only 80 ETFs on the U.S. market. By mid-year 2021, there were nearly 2,300 ETFs, and the total assets invested in ETFs rose from $66 billion to just about $6 trillion. Yes, trillion. That's just in the U.S. alone. In the world, we're looking at $9 trillion invested in ETFs. $6 trillion isn't quite the $25 trillion or so invested in mutual funds, but if current trends continue, ETFs may indeed become as popular as were John, Paul, George, and Ringo. And I would bet that the current trends will continue to gain popularity, especially among institutions and younger investors. Among my own clients, I can tell you that those under 40...
Sample complete. Ready to continue?